Today we are looking at the best European stock to buy now. I am adding this to my portfolio and we're going to run through. The company is Rightmove PLC, is the UK's #1 property website for sales and rent. We have a lot of information. We're going to go through some phenomenal financial metrics. We're going to look at the historical performance of the company. We're going to take a look at some very impressive income statement as well as a very strong balance sheet, looking at their health, their total cash versus total debt. We will touch upon as well some of their competitors within the interactive media and services, looking at their total return year to date as well as the last 5 years. Again, we will run through some phenomenal financial metrics and looking at their dividend safety. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. Now, for those that don't know, Rightmove earn their money by charging essentially a subscription to estate agents to list properties on their website and a variety of services to help agents market their properties. Now, year to date, it is down 6%, and as we can see, it is trailing towards the mid to lower end of the 52-week range. It does currently offer a yield of around 1.9%, and this is the ticker symbol for the US investors. For UK, it is RMV, and as we can see, the price does slightly change. Now, in terms of the last 10 years performance, now shareholders who would have been holding would be up around 38%. Now, this doesn't include those dividends reinvested, but again, it isn't the greatest return on any investment over the last 10 years. And what we want to see today is this a very cheap price for Rightmove? And can we expect to see this share price triple or even quadruple over the next 10 years? And seeing that yield on cost grow to double digits. Do note as well, the market cap is very small at just under 5 billion. Now, let's take a look at their income statement and their top line growth. And we will look at the last 10 years in percentage form too. Now, what we look for here is around 3 to 7% growth year on year. And what we can see in 2018, 341 million of sales on the top line. Latest annual report around 402 million. So they have increased that top line over the last 5 years. And what we can see on a more granular level, there is some strong growth from 18 to 19. And then it has fallen due to that COVID period. And as you can see from the services of the company, you could argue with COVID, the lockdown, possible houses, slowdown of sales and marketing, that in fact that is a sufficient reason for that to drop. And then we see a very strong rebound from 2020 to 21, and then a very small decrease from 22. So there are some inconsistencies, but do bear in mind it has grown over the last 5 years, and we'll check those percentages shortly within the financial metrics. So bottom line net income, how does that compare? Well, 205 million reported in December 2018 on the bottom line. December 2022, their latest annual report, there's a nice increase from 204 to 237. However, when we do look at that granular level, it does fall in line with revenue with an increase to 19 before falling quite significantly in that COVID period to 2020, before then picking up and then a slight drop there. So it is inconsistent, but it does follow the top line, and it is still a strong pair of set of, in fact, income statements due to that long 5-year growth. Now, in terms of the balance sheet, well, how is the strength of that? Looking at total cash versus total debt, 2018, 25 million on the balance sheet. Latest quarterly report around 55 million. So in fact, they have increased their cash balance by more than double over the last 5 years. Now, when we do compare that to their total debt numerically and directionally, what we see is 16 million of debt in 2018. And in fact, they have reduced that debt from their latest quarterly report to 10.7 million. So a very strong, in fact, balance sheet. We do see their cash balance, as we saw above, go from 25 to 54, so doubling. And we see their total debt decrease from 16 to 10, and more than sufficient to pay that off with their total cash. So very, very positive to see. And very briefly, looking at companies in a similar sector, we have the interactive media and services. Now, total return year to date, we do see Rightmove down around 4%, although do note it has outperformed every single one of those competitors year to date. But when you argue it's still negative, that's not the greatest return at all. Now, over the last 5 years in comparison to these, they are up around 9% and they still have outperformed every single peer. Now, again, you can argue 9% isn't the greatest for the last 5 years, but two things to note. First thing is, essentially, we aren't looking at historical data as indicative of the future. And secondly, this is a company that we are looking at from the sense of over the next 5 to 10 years. So just do bear that in mind, and it has outperformed. But again, don't look at historic data with indications for the future. Now, in terms of some strong financial metrics, well, straight away, the market cap is under 5 billion, making it a mid-cap company. Now, dividend growth, and do bear this in mind, this is in British pounds, the payouts, 9% increase over the last full year, 8% over the last 5 years, and double digits 14% over the last 10 years. Very, very strong. And for those that are new to the channel, the minimum we do look for on this channel is 4%. The reason for this, the US inflation over the last 40 years was 4%. Anything less, you are taking a pay cut and losing purchasing power. Now, earnings susceptible to manipulation by management through accounting, so we ignore that. Free cash flow is what we focus our attention on. Below 60% is what we look for. The reason for this is we believe that management will be able to offer those double-digit dividend increases we love to see if it is below that, and consistently below that. In fact, rarely ever goes above 40% other than 2020, which was a poor year due to COVID for them. And we see 21 at 34%, 22 at 36%. So very, very strong to see, which means, in my opinion, we should see those increases in those dividends. Now, earnings per share, again, susceptible to manipulation. So we do leave that out, but data's there for the investors that like to take a look. Free cash flow per share. Now, what do I love about this? 8 cents in 2013, 23 cents in 2022, expected 25 cents in 2023. It is consistently increasing in the right direction, which is very rare for any company. When we look at, they have peaks and they have troughs. You can see here this 2020, the COVID year, was difficult for Rightmove, but they did rebound very nicely. And this is one of the most important factors I always argue on the channel to look at. Whenever a company has gone through a tough time, how do they rebound? And we see Rightmove essentially half their free cash flow per share in 2020, and then it has gone back up and even higher than 2020 or 2019, in fact. So very positive, very consistent. So this is a very strong metric for Rightmove. Now, sales growth, we always say 3 to 7% is what we aim for on the channel for companies we want to invest in. Double digits every single year, in fact, or the majority of the years over the last 10 years. We see how significant that COVID year was for Rightmove, and they did pick up very strong double digits. And bar 2019 and 2022, where they were in the high teens, every other year, very strong growth. And we can see here 140 billion on the top line in 2013, 333 billion in 2022, more than double their top line over the last 10 years. And if this continues, this could be one of those companies in your portfolio to be a multi-bagger in a very short period of time. Shares outstanding, they also do a lot of share buybacks, 1.02 billion in 2013, 838 million in 2022. Consistent share buybacks over the period. Again, very strong to see from any company. Now, ROIC, return on invested capital, do let me know your thoughts in the comments if there are any other companies you have in your portfolio or that you have looked at through a market screener that has such strong ROICs. Now, what do we aim for on the channel? 10% or more. The reason for this, it gives me faith management are able to effectively allocate their capital. I mean, you're looking at the triple digits for the majority of the last 10 years. 310% in 2022. This is absolutely phenomenal, and this is one at a minimum I would ask for you just to consider and look and put in your watch list and see whether or not, based on your own due diligence, this is a company to add to the portfolio. Operating margin, free cash flow margin, you are looking at a phenomenal company. Look at these operating margins and the free cash flows, and note in their poor year, whilst it did dip, it did then pick up very strongly, and the dip is barely that much when you consider how strong this company's margins have been consistently over the period. Operating margin, we look for around 12% or more in this industry. It is well above that. Free cash flow margin around 7%. So absolutely phenomenal. And another strong metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. What do we see? 2022, it wouldn't even take them 1 year to pay off all of their debt net of cash on hand. So very, very strong in my opinion. Now, stock valuation model will run through to get to our intrinsic value. And as always, if you do enjoy the content, value is being provided. Do hit that like button, do subscribe and hit the bell to be continually notified of videos as they drop on the channel. And if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on the pinned comment below. Now, typically, Graham's valuation formula would be the first model we use. However, as we mentioned, for companies that have a strong growth and very rapid increases, as we see double digits every single year, this model is less relevant. But we will show you how we would do it if we were to run through in any other company. We have the stock ticker, earnings per share, growth rate per analyst estimates, as well as that current yield on AAA corporate bonds, which would give us an intrinsic value. So then we move on to the first model, and that is the multiples valuation model. Note that these are all in GBP pound sterling. We have companies in a similar sector and size. We have Foxton, Savills, and Interactive Corp. Their stock price, earnings per share, P multiple, to get the average and multiply that by the earnings per share to give a multiples valuation price for Rightmove at £3.20. Now, when we compare that to the current trading price based on the London stock market, which is at £4.80, that is below the current trading price, and therefore it does show signs of overvaluation to the current market value. But bear in mind, we don't look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have the yearly dividends, as we can see here. Now, do bear in mind the average growth rate. Now, when we take a very quick look, we can see they have had some very, very strong dividend growth over the period. So we will be using the 8% for the annual dividends per share for amounts per sterling. So based on the 8%, what we have gone for forward looking is a growth rate of around 6.5%. Now, you could argue that is quite high and you want to be more conservative, or you could argue you'd want to be slightly higher. If you do grab a copy of the model, you can use your own estimates and analysis to get to your own DDM price, as well as prices throughout the model. So this gives a DDM price of £6.25. As we can see, that is well above the current trading price and above the highs. Even the 52-week high we see here, £6.15. So slightly higher than that 52-week high, showing signs of undervaluation in the current market. Then we have the DCF model, the discounted cash flow, where we have our free cash flows year on year, with the average growth rate coming at 9%. Now, forward-looking analysts are estimating 3%, and in conjunction with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, and we get to the equity value, which we divide by the shares outstanding to get a DCF price of £9.54. Again, well above that 52-week high at £6 and above the current trading price, showing significant signs of undervaluation in the current market. Now, the intrinsic value, as always, is the average of the three models we have just run through. And again, if you enjoy the content, value is being provided. Do hit that like button, do hit the subscribe and bell button to be continually notified of these videos. Now, the intrinsic value is £6.33 with the current price at £4.90. Now, a typical margin of safety, I'd advise, would be around 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. Up to 10%, and your acceptable buy would be £5.70. If you were looking at 20%, it'd be £5.06. And for those who are looking for a larger margin of safety at 25%, your acceptable buy would be around £4.75. Now, personally, I do see this as a strong buy, and I am adding, you could argue between 20% to 25% is where it currently sits at today, and that is for me an acceptable margin of safety. Now, Wall Street, what do they forecast for the price? Well, they see some very strong upside to their current trading price, well above the current price of £4.90, slightly lower than the intrinsic value at £6. As always, though, do let me know your thoughts in the comments below. Is Rightmove one you're looking to add to your portfolio, looking to sell, or even if you're purely on the sideline speculating? Let me know if you've enjoyed this review of a non-US stock. Don't forget to comment, like if you've enjoyed, value is being provided, hit the subscribe bell if you haven't already. And finally, if you do want to grab a copy of the valuation model to get your own intrinsic value or acceptable buy price of companies in your own portfolio, do click on the pinned comment below. And if you want to join us in the Discord where we're talking about buys and sells in the market this week, last week, and looking forward, as well as stock market and finance related queries, then do click on that Patreon link below. As always, have a great day, catch you on the next episode, and take care.